So, hello and welcome to this week's instalment of Nucleus Investment Insights. And today we're going to be looking at all things ethical. So we've entitled this one, Ethical Investment Essentials. I've got my cup of chamomile tea here, and I'm joined by our Nucleus Wealth and MB Funds Head of Investments, Damien Klassen. G'day, Damien.
Hi, Tim.
Let's jump into it. So we thought we'd kick off with an agenda. So we're actually going to start with just a quick update on some of the things that have happened locally and in the ethical world before diving into the main body of today, which will be looking at defining ethics in investment, looking at what investing ethically does mean to potentially to a portfolio or the performance of a portfolio. We'll then be looking at the various options that people have for getting their ethics into their investments and also their pitfalls, and then finally having a look at the way that we approach ethical investment here at the MB Fund and at Nucleus Wealth. So with no further ado, let's jump into it. An update, Damien.
Yeah, look, just we thought it was well worth going through ethical again. We sort of run this about once a year. We sort of have a bit of a look through our ethical side, and there's been a few announcements out recently that were the sort of prompted us to have a relook at this. So and a bit of a win, I guess, for activists on the Woolworths side. So Woolworths announced it's divesting its gaming operations and sort of going to focus and partly due to community concerns over those gaming. So I think there's obviously a feel in ethical investing. You always have to wonder whether you're doing anything as you're doing the investment. And I'll make the argument a little bit later that I think buying stocks for ethical reasons doesn't create a lot of value, but I think selling, but not buying stocks or not owning stocks in sectors for ethical reasons, I think that does have an effect. And I'll go into more detail later about why I think there's a big difference between whether you're chasing the latest, say, solar power stock versus trying to make money from that, or versus not buying a stock that's involved in something ethically that's a bit that you don't agree with. Yeah,
sure. Just a quick one there. So mentioning before Woolworths. So
yep.
To a lot of listeners, perhaps they didn't know that Woolworths did have a reasonably or quite a sizable input into the gaming. So what was the background behind that?
That's part of the hotels,
right.
the Australian Hotels Group, and so they and they bought into that and had the gaming exposure. So it's not as a proportion of Woolworths' total
revenue.
It wasn't massive, but
yep.
it was significant enough to warrant, say, for us to take it out for people who didn't want gaming. That was one of the stocks we would exclude from portfolios for those people.
And so by hotels, it was like pokey venues. Yep.
Yes.
Okay. Sure.
Yes. The other one earlier on this year, actually possibly even late last year, was Unilever and some animal testing. So basically, we run a few different screens within ours. One for companies that are screening. One for companies that are testing on animals for medical purposes, and then another one for people that are testing on animals for any purposes.
Okay.
And so, generally speaking, that's cosmetic companies most likely, and they're the ones most people who are worried about this tend to knock it out. And Unilever was one of those companies that was testing on animals for some of its cosmetics and shampoos and things like that. And now it's come out and decided not to. And the groups we use PETA often their lists of acceptable products, and Unilever products have now been removed from that list. And so It's another one where we were excluding it from people's portfolios who were who had an aversion to animal testing, and now the company's come good, and now it's gone back into portfolios.
All right, yeah, fantastic.
So the idea there is that two quite prominent examples of where ethical pressure from people has made a difference to what companies are doing. Okay,
sure thing. And our last one there on the updates.
Just we've put in so we cover the World 1600. It's called the MSCI World, and which is sort of the largest stocks in the world. And there's a stock that's popped in there recently was a cannabis stock, and so we run a number of ethical screens, and we allow people to knock out stocks they don't want, and so we've added that that people don't have to buy cannabis stocks. We don't actually own it at the moment, but if people who don't want to buy cannabis stocks can knock them out of our portfolio. With the irony, I guess, that we've discussed on several occasions that Often people who are seeking green investments,
seeking green elsewhere.
Exactly, might also be seeking for.
Oh, look, I think, it's like anything, though. For those that have got an aversion to something, then it should be in there. So,
exactly, and that's a lot of the theme you'll get from as I talk through ethical is for us, it's all about individual choices. It's not about saying, it's very hard to find a fund out there and say, I'm going to invest in an ethical fund. It's very hard to say, well, here's one that exactly lines up on every attribute of my, what I think are ethical investments or not.
100%, yep.
Yeah, so it's obviously a lot easier if you can customise it to yourself.
All right, sure thing. So we'll dive into some definitions here. So we've got, and for those that are listening in, I'll pop up the slides as I normally do in a link in the show notes in the podcast. I'll run through. So we've got what's been termed, I guess, in the industry and sort of knocking around with a few people who do a lot of this sort of ethical investment sort of specialty. They typically class investors, at least perhaps without them knowing, is a range of light green to dark green, I guess. And so we've got an arrow here showing sustainable investing sort of being at the top end of the starting point of
the lightest green,
the lighter green. That's right. Moving through to socially responsible investing before then finishing at the dark green end, I should say, of full ethical investing. Did we have some notes just to talk about those broad categories?
Yeah. So there's a couple of different ways you can cut ethical investing. So this one's sort of talking about how sustainable generally the investments being chosen on how well companies managing environment, social and corporate governance factors, not as much about what the company actually does. Mm-hmm. So it tends to be more of a relative investment. So you might find that you've invested in an environmental fund and you look in there in Woodside Petroleum, and you're sort of like, just a minute, here's an oil company. What am I doing owning an oil? And we've got this global warming is one of the biggest issues. And they say, well, yeah, but it's actually primarily a gas company, and gas is better for the environment than oil, and particularly a lot better than the heavy oil that you get from, so the Canadian tar sands.
Tar sands, yep.
And so we'll buy that company because in its universe, it's actually better than its competitors. And so for some people, that's fine. They're happy to say, well, I just want to tilt a little bit. For a lot of people, though, then go, well, just a minute. No, if I'm against global warming, I don't want just a little bit of global warming. I prefer to
rub it completely out. Yep.
Yeah, let's go for stocks that are actually going to help.
Sure.
So then you can get socially responsible, where you start to screen out companies if they're involved in these excluded activities, and you sort of try and make an assessment as to the positive impacts versus the negative impacts. And then finally, you have the ethical side, where you're basically just saying, well, look, if it does this, I'm not investing in it. So the socially responsible investing, you might, the sort of middle ground, you might try and make an assessment and say, well, this company is, for example, one of the companies we own is Neste, which is an oil refiner, but they're very big into renewable and trying to come up with solutions for a renewable side. Mm-hmm. And so some people might then say, okay, well, actually,
they're proactive.
They're proactively trying to change that industry. Yep. I'll actually invest in that one.
Okay.
But the reality is they still have some oil, and they're still producing sort of biodiesels and various things like that. So at an ethical side, you might just say, well, no, I just don't want any of that.
Okay. So
you've sort of ranged from your sustainable investing, which is it's a Woodside. It's still involved in the industry heavily, but it's at the better end. Versus the socially responsible, you might say, well, Woodside won't make the cut, but I'll actually invest in some of the Neste that is actually actively trying to get to a greener future. To the ethical side, which is saying, no, I just want different. I don't want anything involved in that. I'll just go straight to solar power or different technologies.
Okay, sure thing. It's just interesting, just before we roll on to the next one, that I saw that Norway has just come out reporting that they're over 50% of all new cars are now electric vehicles in Norway.
Yes.
And so they're lauding themselves as, obviously on the forefront of this electrical thing, but you might have something to add about where the bulk of the government revenue comes from in Norway.
Yeah, well, I mean, it's a good example, though, so Norway's got some huge oil funds and they make a lot of money from it. So they're basically piping the proceeds of oil into getting people into electric cars, which Yeah, people need to make their own assessment as whether that's a good thing or a bad thing.
Yeah, no, I saw that one. I thought that was interesting, given we were talking about ethical things today. So we'll roll on to some further definitions. So we've got an often termed, what would you say, acronym, ESG for ethical investing: environmental, social, and governance.
Yeah.
Just quickly run through those.
So you've got three different ways that most people tend to look at the stocks that they're going to decide what to invest in. So the environmental side is coming back to literally the natural environment. What they're doing to what sector generally they're involved in, and is it something where it's renewable or it's something where they're using up resources. And you might look at animal treatment and other factors along those same lines. Social gets more into how they're managing relationships with employees, suppliers, customers, communities that it operates in. It's often a bit harder to measure the social side, and you can get some significantly different answers depending upon who's actually compiled the social measures that you're using. So there's a number of different vendors out there that sell ESG data, and the social one is where I find you get the most divergence in that one company will have a company that ranks quite well, and another one will rank quite poorly, and sometimes it's the weighting between what they're doing. Sometimes it's for example, a mining company with indigenous jobs is usually thought of as a good thing.
Yep.
But they might have
well, they're obviously
they might have taken some land originally from indigenous tribes, or against won some court battles against indigenous tribes to actually get the mining going in the first place. And so then it's a matter of one person might well say, well, all the court cases will outweigh the benefit of hiring a few people back at the end of it, and other people will say, oh, no, the jobs are better and so it does get a little bit woolly within that whole social side.
And just on that as well, I guess another example might be something like Facebook, where on one side you've got the fact that it's very connective and it's got the ability to join people all around the world and do all these wonderful things, and then of course you've got the other side, which is just pure data security and
fake news,
and all those sort of things as well. So depending on the attitude of the assessor,
absolutely
score higher. Yep. Okay.
Yeah,
sure.
you find that's the hardest one to judge. And then finally, the governance side, and that tends to be a bit more, a little bit more mechanical, but it is that coming back to do you have a diverse leadership? Are there controls? Executive pay? What are shareholder rights? And so you can often get, and again, within this part, you can get some very diverse outcomes where you get companies like Google, for example, that have a number of quite good governance mechanisms and setups. So let's say their board is very broad and very diverse, and doesn't have and a lot of independent directors, and so they tick all those boxes. On the flip side, they have a voting, non-voting shareholder structure that's sort of designed to try and put more power back into some of the original owners.
Right. Yep.
And so, which one's more important? I don't think anyone's, everyone's got their argument, and you can always come up with cases on either case where you went, well, here was a place with an independent board that did a terrible job, and here's a place with a dependent job, that did a great job, and so you can always come up with counter examples to all of these. It's just a question of trying to weigh up, but I think within governance, we find certainly that if you have your measures of what is good governance, and you don't buy companies, or you at least put a much higher hurdle on buying companies that don't conform to those, you avoid a lot of the real blow-ups and a lot of the real concerns where it's insiders and related party deals and there's you can see that the worst, you can avoid the worst ones. You'll miss a few really good ones as well, because it just happened to be the corporate governance structure wasn't very good, and all that, but they had a fantastic product and a fantastic strategy, and the whole you sort of that outweighed it. But governance generally helps you to avoid blow-ups. So
essentially, I guess. As a summary, so from a governance point of view, the more you know about the governance, perhaps the better, because it's more transparent, even if there might be some signs in there that you could sit on the fence on as to whether or not it's a good thing or a bad thing. The fact that you even know that it's happening is probably better than something where you're just like, well, the governance part is completely opaque and
a black box.
Yeah, yep, okay.
Yeah.
No problems. All right, so we'll roll into where to draw the line, and I guess some key issues. So why do we need to talk about ethical investment over just regular old invest me anywhere investment? So what are some key areas there?
So the biggest issue for everyone is how much is this going to cost me? Because at least when you go to the egg aisle at the supermarket, you can see here's my free range eggs and fed by hand and all that type of stuff like that, and that's got to cost me X dollars, and then I've got my let them roam free in the barn versus lock them up in a cage and pull them out, and you can see how much is it going to cost me to be very ethical, a little bit ethical, not very ethical.
Yep, sure.
Unfortunately, it's not as easy in the investment performance side, and so I've got a few slides I want to run through to try and say, well, how much really should you expect it to cost you?
Yep.
The next part is then how the stock's chosen, and we ran into a little bit about that, but it does matter so that if you are anti-carbon and you've invested in an ethical fund and you find yourself owning all these oil and gas stocks because they're gas stocks rather than oil, that might not sit well with people. So you want to make sure that you do know how they're choosing it.
Okay.
And the last thing is fees, because there's a number of ethical funds within Australia that charge much higher fees than what you'd see elsewhere. And actually, a lot of them charge retail investors a lot higher fees than what they charge their wholesale investors, dramatically higher fees.
For the same product, essentially.
For the same product.
Yeah.
And it's that doesn't seem particularly ethical to me. And a lot of the time, there's not a lot of extra work that's going into this.
Yep.
It's more done as people want. When I find somebody who wants ethical investments, they'll be prepared to pay for it.
Yeah,
it's
sure.
Sort of the I think is possibly what the marketing spin on some of this is. So yeah, I just want to go into that side as well.
Okay, looking forward to that. So we'll kick off with the effects on performance. So reducing the opportunity set. You might just need to run through what that means to the layman.
Yeah. So what I mean by this is there's my universe 1,600 stocks to invest in around the world. If I've got to try and find the best. We sort of run 60 to 80 stock portfolios, and so we've got to find the best 60 to 80 stocks that we think is going to outperform over a period from that. If you then go and say, I'm going to reduce that opportunity, you can invest in 1,600 stocks. You can only now invest in 800 stocks because I've knocked out anything that's not ethical. Now that manager's got to go and try and beat me with one hand tied behind their back.
Yep.
So the idea is that in terms of performance, you are most likely going to have a negative performance because you have a reduced opportunity set. The good news is it's probably not going to be much, and in some periods it'll be positive, and other times it'll be negative, assuming that you haven't knocked out huge swathes.
Yep.
And so for me, it's about trying to say, well, if I can look at that 1,600 and go, well, there's 100 stocks that I really don't want to invest in for ethical reasons. And Tim, you might also have 100, but it's a different 100. Well, rather than giving it to one ethical manager and knocking out all 200 to make sure you've suited both me and you, you're better off finding products where you can just get your 100 stocks knocked out. I can get my 100 stocks knocked out. We're both happy, and we're both got enough of a.
So it's fit for purpose, sort of, in a sense.
Exactly.
Okay,
and we've both got a best potential to outperform. But having said that, there are periods where these stocks have outperformed. I've got a slide up now. Basically showing the oil and gas sector over 2016, where we saw the oil price, dramatic fall in the oil price, and was terrible for oil and gas stocks.
Yep.
So ethical funds over that period generally outperformed non-ethical funds.
Yep.
Not because they had a great insight into the oil market. It was just they weren't allowed to buy oil stocks, or ethical stocks that didn't buy the oil sector.
So they effectively just excluded themselves from a bad performing sector.
Yeah,
more than anything.
And so at the time there was lots of articles out there saying you can have it all. You look at these. Ethical funds are outperforming non-ethical funds, and everyone should invest ethically. And so. I think that's a bad message for people who want to invest ethically to say, well, you're going to make more money and you're going to outperform and you're going to get to be ethical because I don't think in the long term you will, but I don't think the cost is going to be very much depending upon how much you're knocking out, and so that's one example of a bad case. The other another example is sort of 10 odd years up to about 2016 for tobacco stocks, where tobacco stocks just had a roaring run over that period. There's a lot of funds out there that are ex-tobacco, and so they tended to underperform the market because
they're missing out on that sector.
Missed out on that sector that just had a fantastic run.
Yep.
And so it's not again, you can't say to these guys, oh, you guys did a bad job because you knocked out that sector. But you do need to say, well, if I don't feel strongly about tobacco, if I just think that's somebody's choice and people have the right to buy it, and if people have the right to buy it, then people must have the right to sell it as well and make a profit.
Yep.
So if that's your view, then
you're losing out by choosing
if you've got a fund that's automatically knocking out the tobacco stocks. On the flip side, if you're saying, no, I lost my partner to cancer or whatever it is, you know, and you do feel that they're ethically wrong, then you do want to knock out sort of just that part without losing some of the other parts.
Fair enough. Yep. Okay. Sure thing. We've got up here now the next one. Corporate governance is the exception. Yeah, the exception.
Yeah. So we run a number of different quantitative screens that sort of look at performance for companies in the long term, and the things we find work best over the long term is finding stocks that are value, which is basically they're cheaper than average. It depends upon whether you're measuring it versus themselves, whether measuring versus their sectors and versus markets. So there's a whole bunch of different levers, but generally speaking, if you can buy companies that are cheaper, you tend to do better. If you can buy good quality companies, they tend to do better. And one of the and when I say good quality, I'm talking about companies that earn good margins, have stable earnings,
diversification.
Well, not always diversification, but economic moats. They talk about in the Warren Buffett talk. Yep. Earning good returns on equity, so they're investing money wisely. And corporate governance is one of these factors that feeds into quality. And there's a bit of it's a little bit chicken and egg sometimes. Does the good corporate governance mean that they earn better margins, or do you find companies that are,
earning good margins attract different people, the right people?
They can afford to have better corporate governance or whatever it is.
Yep.
But there's certainly effect in terms of performance where we look at the environmental and social side and say it's very hard to say. We think there is a slight negative performance you get from those two. If you chase good corporate governance, though, we don't think there's actually you're not giving up anything by chasing good corporate governance. So that's one of the factors we sort of put into our investment methodology. And truth be told, there are a lot of other people that do also, there are a lot of investors out there that incorporate corporate governance into their investment process because it is a good
indicator,
and a good way of avoiding the really bad ones.
Okay, yeah, sure thing. We've got a couple of examples up there. So we've listed caveats being Facebook, AMP, and Commonwealth Bank. Do you want why are they caveats?
They're just sort of. I guess we're just talking about some blow-ups over the recent year or so, where stocks that have
We're typically known for good corporate governance, or
well, no, I think there's certainly. The AMP, for example, is certainly not known for good corporate governance at the moment.
Not now, anyway.
Not now, but for a number of years, you got some good performance, and CBA as well certainly came out of the Royal Commission with its reputation down a few notches for its corporate governance, but it's been one of the best performing stocks over the long time, and Facebook is the other example where similar, got some issues with corporate governance and I guess Zuckerberg's control and factors like that, but it's been one of the best performing stocks. And so you do have caveats where you can get away with bad corporate governance for a long time, and then the question is, if AMP, obviously suffered eventually. And the question was that it actually hit a stage where there were questions about whether should its license be
removed,
keep its license or not, and Facebook's facing similar questions about whether it's obviously been given a social license to operate, and have been questions asked. I don't think they're serious at the moment, but there were questions asked about does it need more regulation and more control, and so I guess what I'm saying with the corporate governance side is you can get some exceptions to it, but you got to watch out for the snapback on those ones as well, because you can get if you're getting away with something for a long time, and then eventually it comes home to roost, and you suffer it all in one hit. Okay,
yeah, fair point. So rolling across to performance. So what I guess, we were talking before about obviously, the one hand behind the back as an ethical manager. You've got less stocks to choose from to try and match up with the guys that have got more opportunity or more choice.
Yeah.
So how much impact are we typically talking about for these sort of ethical themes?
Now, it is very difficult to say, and there's a lot of assumptions that go into this, because basically what your big assumptions are, do active managers do anything? Which is as an active manager, I like to defend and say yes, I think we do, and I think there's certainly risk mitigation and a whole bunch of other factors.
Yep.
But there's a number of studies that say in aggregate, active managers make a certain amount of money, and they generally outperform the market.
Mm-hmm.
But then if you're an investor in those quite often what happens is the fees are enough to bring you back to average market performance.
Right. Okay.
So, So the question is, if you think that active managers can do something, then by giving them a broader opportunity set, you've now got a better chance of outperforming.
That makes sense.
If you make the assumption that active managers they're terrible, I should just always invest in an index fund, then in theory this isn't doing anything really to an active manager's performance, because it was a random random outcome anyway.
Yep.
So so that's one side of it. The other part is then saying how many stocks actually get knocked out and looking at those different factors. Look, for our, we think it's less than 0.5% for most people when we look back at our customer base and what they're knocking out.
So when we say that, that's per screen or per broad screen or
for
overall?
For overall, as a broad screen, if you knocked out, we have about 20. If most people would knock out 5 or 6 different sectors, or areas, and we think it would be less than 0.5% performance hit to most of those
per year.
Yep. And some years it's up, other years it's down, and it really does depend as well. Like the big one we've included there is the energy sector.
Yep. Which has a huge impact, as we saw.
Yeah. And that's the main thing is saying how big is the sector. So if you cut pornography out, nobody makes money from pornography anymore, as we've said. It's all free.
Sure.
There's no actual companies that's going to affect. Old growth forests. Within our universe, there's no big companies that are out there logging old growth forests
at the moment. Yeah.
Within our universe. So it does make a difference if you tick the box type thing from a performance perspective at the moment.
Yeah, sure.
But even if you did, the stocks that are involved are so small as relative to the size of Microsoft's and Amazon's and companies like that, it's not making a difference.
Okay.
Whereas when you pick the energy sector, okay, now you're taking a decent sized bet on, is it too cheap or is it too expensive?
Yep.
And the argument would be sometimes, the tobacco sector was a good example, was a lot bigger, but there was a lot of pushback against tobacco, and a lot of funds went ex-tobacco, which then arguably made the sector cheap enough that the performance over that 10-year period that we pulled up before was partly because a lot of people are sold out for ethical reasons. Now gives you a better performance going forward.
Yeah, sure. Okay.
So,
fair point.
So there are some issues around those, but I would, my estimate for most people is going to be less than 0.5%, but it really does depend upon if you pick a whole bunch of big sectors, then it could be anywhere.
Sort of quite marginal. Okay.
Difference.
Yeah, sure. Okay, very good. So from that note to, I guess, the more mechanical sort of side of how ethical investing is actually done in a portfolio. So we've got a range of options here: positive screening, negative screening, and best of breed. We might just want to quickly run through those 3.
Yeah. So 3 ways that, and most funds sort of pick one of these. So the positive screening is where you say, I'm going to go out there and look for companies that are going to save the world for us. So I'm going to invest in solar manufacturers and wind power and other sort of companies along those same lines. The negative screening is ones where you're saying, okay, well, I don't want to do no harm. I don't want to invest in things where I don't ethically agree, and so I'll knock out my carbon or whatever it is. But I'll still own other stocks in the universe.
Yep. Which is what we use.
Is what we use, yep. And the final one is the best of breed, where you start saying, the Woodside example I used before, where you say, okay, well, let me look at the whole oil and gas sector. I'm not going to buy the tar sands, and I'll limit myself how much oil I get, but I will go out and buy gas stocks because they're the sort of better end of it. So the question for me is, the first question before you decide which of these suits you the best is work out, why are you interested in ethical investing in the first place? Because you want to, I'm assuming it's because you want your money to do something good for the world. The positive, and that's where the positive side of it really doesn't gel right with me. If I go and find a solar manufacturer and I go and give them lots of money, and I go and buy their stock,
and bid it up effectively.
Bid it up.
Yeah.
I've just given money to another investor. Like, I might feel good about saying, oh, I'm helping these guys out, but really all I've done is taken my money and given it to another investor at a higher price than what the stock would have otherwise traded at. The company itself is still operating along. They're not, they don't care whether it's me or whether it's you that owns the stock.
The shareholder. Yep.
Yeah. If the share price is a little bit higher, they're probably slightly happy, but the net effect of me doing that. So, and the question then comes back to saying, well, if I look at those and I say, here's a solar manufacturer where, the Chinese government's, they've got a competitor in these Chinese solar companies where the Chinese government's subsidising and throwing all this money at and trying to turn themselves into solar superpower. Should I still go and invest in this solar company, knowing that, yes, it's probably going to help the world a little bit, but I might lose money. I'm probably going to lose money on it, or I'm going to get a subpar return on it. Should you still go and invest in that stock? And probably not. No. And so the question for those is saying, well, if you've got your money and you're trying to make the world a better place with it, go through your list of what's going to help. The best thing you can do is make a donation for most of these. So I want my money to do it. I'll take a tax deduction up front. I don't invest in that solar company and lose money on it and get a tax deduction in 5 years' time. I'll actually give the money to a climate change fund or something that's actually going to go out and try and help the situation. So make a donation is your first one. Second bit is buy the product yourself. If you've got a company that's choosing between taking $10,000 of your as buying shares or $10,000 to buy some solar panels on top of your roof. Most companies should want you to be a customer rather than and the ones that don't, the ones that are looking for investors rather than customers, you don't want to be investing in those companies. so yeah, but buy the product yourself. The third step is actually take place in a capital raising. So the company is raising money to open new factories or do something, and they're trying to bring money in. So you're actually buying the shares from the company. Your money is going into the company. The company is then using that to go and invest in something. So
further the cause.
So now you're helping.
Yeah, sure.
But if you go out and buy from another investor on the market, for me, that's doing
not
very
much.
Little. That's the social equivalent of clicking your like button on your Facebook page, but not bothering to go to the protest. It's a bit of an empty gesture. And so I guess what I'm trying to do is say to people, well, if you'd like to be involved in ethical investing, the negative side I think is important, which I'll get to shortly, which is don't buy stocks that are doing stuff that you don't agree with, and sure. you wouldn't decide to make money from clubbing baby seals, which might be a very profitable business, and and all that sort of stuff, but you don't want to make money from it, so don't
just step out of it. Don't
want to make money from gambling companies exploiting people or tobacco, whatever your personal peeves are. That's you extract from those, but chasing companies for positive ethical reasons, I don't think is particularly helping. Get out and make, and I should say, making a donation isn't tax deductible generally to a company, but if you're looking for an ethical cause, there's bound to be one. There are funds. There's other places to, there's definitely bodies out there or research companies or whatever it is where you can you can help out with your money.
Yeah, sure. Okay, very good. So we'll jump across now to fees. So we touched on fees before. So typically you expect to pay more for the ethical options involved in a fund. How much more?
Yeah, well, we don't charge anything extra. It's not particularly expensive nowadays to buy ethical screens from a range of different sources, and to if you've got analysts looking at stocks and they need to have a look at an ethical side as well, you're probably already looking at the governance side. A lot of the ethical and social side is either done by, you can sort of get feeds, and certainly large companies give quite very good disclosures about what they're doing. I can't see a reason why you should be spending more money to invest in a company that's buying fewer stocks. So the research effort involved should be similar to other ones. And so I would say, have a good look at the fees, because there are certainly a number of ethical companies out there that are charging fees that I don't think are ethical to charge.
Okay, yeah, sure.
Retail investors.
All right, fantastic. We'll dive into the practicalities as well. So we've got some broad ethical thematic options for those that are thinking about, trying to assess the options essentially for what's available to your everyday investor. So we sort of start off with managed funds, and I think from memory, so we've got a price scale. So essentially, you often find the managed funds are at the more expensive end, unitized structure, reasonably opaque, but they will, follow a preset set of rules essentially that you can find on the literally on the packet. You then roll into listed investment companies, which have sort of surged in popularity in the last sort of few years for a number of reasons, not always ethically charged, those ones, but at the same time there are a number of ethical listed investment companies out there.
The thing I'd say to note with the listed investment companies is that quite often the broker, one of the reasons why listed investment companies have gone so well recently is because brokers and financial planners can charge a fee to when they're raising money to put you into it, and they've been banned from doing that on all these other products. So
That's
basically,
it's a bit of a loophole in the rules.
You give somebody $100,000 to buy a listed investment company, quite possibly $1,000 or $2,000 of that ends up in the pocket of the person who just told you to
facilitate
buy this product.
That's right.
Whereas if you buy a managed fund from them, they're banned from doing that. They're not allowed. They're not allowed to take part of your money. In listed investment companies. They are, and so that's why if you hear somebody selling it to you quite hard as to why you need some, quite possibly that's why they're very interested in your
review their ethical bent.
Exactly.
And then finally, finishing up at generally the cheaper end of the thematic options are exchange traded funds. A host of them coming out. There've been quite a few that have been listed out there for a while. Look, a question to those is they are typically, and we'll jump into an example in the next slide, quite broad, because they are in a sense they're kind of mass marketed in a way. They go, okay, well, if you want ethical, we're ethical, and then you say, here's all the things that we can do, and I think we sort of start running into some of the issues we spoke about in the past, where you do sort of potentially miss out on areas you're ambivalent about.
Yeah, and so keep in mind these are the listed. These are the product type versions, and then you get the ones that are a bit more of a service, which is more similar to what we're doing, or people running sort of managed discretionary accounts where they do it as it's a mix of letting you customize and letting you actually tailor things, rather than these are sort of off-the-shelf products.
That's right. Yeah, spot on. I'll just to follow on from that ETF sort of theme there, we've got a rather big one there, the BetaShares Global Sustainability Leaders ETF. And as you can see, big general sectors are sort of excluded there. So fossil fuels, tobacco, nuclear energy, etc., animal cruelty. So as I said, it's one of those things when you're creating a product, you try and get 95% of the tastes of what you think an ethical investor needs, but then of course you potentially if you're going in for one or two of these things, you're unfortunately wearing the performance headwind of all the other ones as well. Yeah,
and certainly there's a lot of products in there. We've discussed a few times that saying alcohol. If you're happy to drink it and you're happy for people to sell it and make a profit from it, then should you say, well, no, I won't invest in any company that does it? So
yep, absolutely. Touching on before with Damien mentioned, so the tailored, so more not so much the off the shelf, but now talking about the tailored sort of thematic options. So an easy one is going to see, and there's a number of guys out in the market that do the face-to-face, individual, tailored, fully fledged, super specific, bespoke, but also obviously coming at a cost of that sort of manual intervention through to constructing the portfolios. As you mentioned, they quite often use managed discretionary accounts, which is a platform sort of style aggregation of portfolios or of shares, so it's easy to manage and see. And then the flip side being then a style of account that we use called separately managed accounts, which still gives you the individual share ownership and the quarantine of franking credits and distributions and those sort of things, as if you own the portfolio yourself, but also brings with it much cheaper brokerage costs because the account provider can aggregate those trades. And
within those separately managed accounts as well, you can see exactly what you own. There's a court case I think last year where somebody, I think it was Australian Super user, was trying to try and find out whether he owned fossil fuels or something within his portfolio.
Oh, yeah.
There was
Host Plus, I think. Anyway, we won't name too many names.
Yeah, that's right. That's right. We won't name anyone.
It was a major super fund.
It was a major super fund where, and it's that part about the transparency is very difficult. Like if you say well, I've given you whatever, $100,000 of my hard-earned super money. Can you tell me if I've invested in anything that's in the carbon industry?
Yep.
Quite often they can say yes, we can, but we can't give you specifics because we don't know.
Oh, look, absolutely. And look, my time in the large funds, there was always a call for people for two things. I guess one was to invest ethically, and there's more often than not you'll find there's a sustainable option in most super funds. But that's sort of funny in a way because it's saying, well, you're either not ethical or you are ethical. And then when you are ethical, that's it. You just knock out everything. You're warts and all ethical, or you're the opposite of ethical. I guess it might be evil. Anyway, we'll move on. So look, speaking of which, so flipping it on its head a little bit, and certainly the large funds and the example I just gave is more of a top-down approach. Okay, let's just wipe out everything and create something that's sort of fairly easy to understand and go from there. We approach it slightly differently, Damien, with the way that we have our ethical screens.
Yeah, so as we discussed, for me it's all about tailoring, getting back to knocking out just the things you're interested in, and acknowledging that even within some of them there's a spectrum. So, for example, within war, there's quite the quite common ones we knock out are cluster munitions and landmines. Yep. They're sort of against the UN convention, but the US isn't a signatory to that, and so there's still companies in the US, large companies in the US that produce them. So that's one way people say, well, no, I don't want those. And then there's sort of a more general war where you say, well, are they involved in any military
intervention or
products
involvement?
Or
yeah,
whatever.
sure.
And so you might find something like a Boeing, for example, is a good example of a company that supplies planes to the US military. And so, but they're also obviously a huge civilian fleet as well. And so being able to give people that option to say, well, it's not a black or white. I want to be able to say, well, yeah, let me get rid of the worst of them, but I won't cut everything out.
Yeah, sure. And so we've largely just used the high impact versus broad style.
Yes,
is to denote those ones.
Yeah, and we've also had we've had requests from people to add new things, so we're more than happy to add new ones as long as there's reliable sources of where we can get the information to.
Yep. And that just leads me on to a question. So with the bulk of these, because obviously, as we mentioned before, there is a cost essentially to research and all these sort of things. So, do you mind just quickly running through how some of the these impacts, I guess, are figured out? So for us, we knock out individual stocks. Is there, you don't have to go through all of them, but maybe just hit off on a couple of them to show what we use?
Yeah, so we assess each company, as we're putting it into the portfolio, we assess it against each one of these factors to work out which one is it involved in, partly for investment reasons as well, because there are factors that will be affected by regulation and other sort of investment-driven events. Something like the animal testing, we use PETA as a good source for it. Yep. There's within the war ones, we tend to have to dig into what you're looking at what contracts they have. Look, companies that are in those type of sectors, we look at the contracts they have and customers.
Okay.
Within there's some of them are quite sector based. So companies sit within certain investment sectors, so you might have alcohol or tobacco as the sectors we are quite easily to cut out.
Yep, sure.
Yeah. But there are other ones where because we do quite detailed research on the stocks that we buy. So, for example, Woolworths, it doesn't sit in the gaming sector, but as the analysts are going through and modelling each of the companies and working out where it's getting its revenues from and future growth, is that's sort of one of those boxes we tick. Okay, sure. A couple of quick questions, actually, just before we run into the summary. So what are the potential risks of investing in highly promoted ethical companies such as Tesla, who don't have proven product capacity to complete the orders they have taken? So should we be buying EVs even if they may not actually make any money on them? Yeah, well, that is the classic ethical question, and that's why I say that I think there's a negative screen in there saying I don't want to buy companies that have these characteristics. With a Tesla, it's about saying, does this company stack up from an investment point of view? And then should I buy it or sell it? Me going out and buying the Tesla stock from another investor makes stuff all difference to Tesla's success or failure.
Sure.
If I give Tesla money in a capital raising, it helps a little bit.
Yep.
If I buy a car from Tesla, it helps them even more.
Yep, sure.
And so,
if you get it, if it's built.
Yeah, that's right. But so if you want to support Tesla, buying Tesla shares from another investor is, in my mind, the worst possible way to help support that, if that's a company you feel strongly about.
Mm-hmm.
And as you said, the investment side of it may not stack up, and certainly for me, it doesn't stack up at these prices.
Sure.
But or it's certainly already priced for success that it hasn't achieved yet.
Yeah. So. Okay. All right. Very good. Good answer. So thanks, Homer's Odyssey, and then one from James. So we've got on the topic of low fee ETFs. What's your thoughts on the zero fee? I think it's Macquarie True Index options. I've done a little bit of reading in this one. It sort of seems like a bit of a race to the bottom. But so they've rolled out a couple of I think Macquarie's, and they've just done them in the States as well, where they've effectively got a 0 basis point exchange traded fund, broad index. I don't think they're ethical, but
no,
for mine it appears to be a bit of a race to the bottom.
And I think Vanguard. No, it wasn't Vanguard. One of the other big index providers has some as well. No, I hadn't seen any ETF ones. Look, so they're making money on those ones usually from lending the stock out. I'm not actually sure in this case, but I know in the ones I'd looked at. So they're basically saying we'll do it for free because we'll make money on
shorters, basically,
or lending the stock to shorters.
Yep.
Or on a little bit on the trading side, and that's enough. If the fund's big enough, they make enough to
keep the lights on.
To keep the lights on. So for those ones, I mean, nothing's free. So there's generally costs embedded or reasons for people wanting to do these, and sometimes it's just getting access to the flow and being able to do the other side of the transaction. But for an investor, so I guess the answer is yes. I've got no problems with zero fee funds. That sounds good to me.
Yep.
The question always comes back to just working out where are the hidden costs, because none of these guys are doing it for free.
Yep.
Or not generally doing it for free, and so you need to work out, where are the hidden costs acceptable to you as an investor.
So it's like the old Facebook model. If it's free, it probably isn't, sort of thing. Follow
the
money.
Yeah, absolutely. And there was Macquarie was very big in the whole no free. They had a bunch of structured products out there where 10 years ago where it was all sold as free products, free. And what it was they were mispricing options. They were basically selling you some call options plus some bonds, bundled together to give you sort of a similar exposure to the markets.
Right.
And they'd market it as free, but they just basically price their options at a...
Yeah, okay.
They basically sell you expensive options, but you got the whole product for free because they didn't have any explicit fees. They just overcharged you on one part. So, without looking in detail at those ones, they might be fine, but it's worth making sure that you're not being overcharged, say, on the trading or on the other factors of it.
Yep, okay, fantastic. All right, no worries. So we'll jump across now to just the broader points. So looking at, I guess, overall, what are some key takeaways from today's quick chat?
Yep, so just making sure that your ethics are reflected in your management of your money. So, I think most people have jobs that they wouldn't do at any price, and regardless of whether those jobs are legal or not. And so I think there's a good argument for why that should extend to your investments, and then working out the whole that fee side as well is just the key one for me, is coming back to those fees and just looking at the fees, because there are a few people, and it's quite irking from to see companies out there that are calling themselves ethical and charging customers fees
100% more than they would other people for the same product. Exactly. Very good. We'll finish up on that one there. Thanks, Damien, and we'll roll into what's coming up next week. So obviously we've had another rate cut from the RBA, so we thought we'd dive into looking at rates, or lending rates towards zero, RBA perhaps to zero if they can ever get there, and then beyond, and then of course the impacts that will have on portfolios both in the short and medium term. So really looking forward to next week on the 11th of July. Same bad time, same bad channel. Head over to the Nucleus Wealth Live webinar page to listen in and also have your questions answered as we've done today, and we'll look forward to seeing you there. Well, that's it for now, and thanks for watching. If you like what you heard today and you'd like to hear more, head over to nucleuswealth.com/subscribe. Give us your email address, and in return we'll send you a weekly email with new webinar topics, links for our podcasts and other news from Nucleus Wealth. I certainly hope you've got something out of today, as I have, and we'll look forward to catching you at the next one. Cheers.